If you have over $500,000 in your 401k, the IRS could one day force you to withdraw up to $200,000 from your account for required minimum distributions, costing you over $50,000 in taxes. And it will get worse every single year after that. And most people don't even know it's coming. Now, maybe they know they'll eventually have to take their RMD in the future, but they have no idea they're actually setting themselves up for a tax disaster. I'm Tom, founder of GT Wealth, and I've been helping retirees avoid this exact scenario for over a decade. The real problem isn't what people are doing, it's what they're not thinking about. So if you have the majority of your wealth in tax-deferred retirement accounts, this video is for you because it could save you hundreds of thousands in unnecessary taxes. Let me show you what I mean with a real client scenario. So we have Paul and Carol. They are 59 and 60, and they want to both retire at age 67. They've done everything right, saved and invested over the years, and each have close to $500,000 in their 401k with $100,000 in a joint brokerage account. So we're going to jump over to retirement cash flows, and we're going to look at their numbers. Okay, so this summary is broken up between income, expenses, goals, and their taxes. Let's scroll down to where RMDs begin at age 75. And honestly, I'm still shocked by how many retirees are surprised when I show them these two things. First is how much they are going to be forced to take out of their IRA by the IRS. And second is the amount in taxes they are going to have to pay on those distributions. Paul and Carol are going to be blindsided. Look at what happens when they reach age 80. They'll be forced to withdraw over $200,000 and hand $50,000 straight to the IRS every single year, and the amount continues to increase because the account stays invested and continues to grow every year. But also remember, they're also both collecting Social Security. And when you start to get into these higher income numbers in retirement, up to 85% of your Social Security benefit gets pulled in as taxable income. And so these two amounts stack on top of each other, pushing you into the 22-25% tax bracket. And if we look, by age 90, they could be paying over six figures in taxes annually. Now, this won't happen to everyone to this extent, so here's how to gauge if this could be you. First, look at how much of your total retirement assets are in tax-deferred accounts like 401ks, 403bs, IRAs, or SEP IRAs, because all of that money will get taxed at some point. The more you have in those accounts, the higher your tax bill will be down the road. So look, if you have $500,000 in pre-tax accounts and you're within 15 years of retirement, this isn't just theory anymore. You're likely on the same track as Paul and Carol with a high chance of paying $50,000 plus annually in taxes when it comes time to start taking distributions. So here's what you need to do right now to avoid becoming like Paul and Carol. First, let's figure out what you're actually facing. Add up everything in your 401ks, 403bs, traditional IRAs, that's all your pre-tax money. Let's say that's $500,000. Now we need to estimate what that looks like 15 years from now when you reach age 75. And an easy way to do this is to use a simple investment calculator on calculator.net. And I'll include a link in the description so you can do this exercise on your own after the video. Let's assume our starting amount is $500,000. If you're 60, you have a 15-year timeline, and we'll use a conservative return of 6% per year. Let's click calculate, and that gives us $1.2 million. Step 2 is to estimate your RMDs. So let's take that balance and estimate what your required minimum distribution could be. We can go to investor.gov for an RMD calculator, and I'll include a link to this one as well in the description. We plug in our estimated account balance of $1.2 million, then choose your RMD age at year end. So refer to this chart to choose the correct RMD age, click calculate, and that will estimate your distribution. Now, one thing to keep in mind with these online calculators is they're very generic and don't take into account your personal situation like other income streams you could have in retirement. So that's Social Security, pensions, investment income, or real estate. But it will at least give you an idea of where you'll be. Next, let's work backwards to find solutions. Now that you know what you're facing, let's work backwards from that big number. How can you start reducing those pre-tax balances right now? Maybe it's looking at Roth conversions in low income years. I actually did a video going really deep on this topic. I'll link it in the description to watch later. Or maybe it's taking strategic withdrawals before RMDs kick in. Or if you don't need the distributions to live on and charities are important to you, you can do what's called qualified charitable distributions. The goal here isn't to eliminate all taxes. That would be great, but unfortunately it's impossible. The goal is to be aware that this tax bomb exists and start thinking about what you can do about it before it's too late. And finally, and this is probably the most important part, focus on funding your life, not the IRS. Now and only now do you look at your RMD in context. Maybe you need to take more than the minimum. Maybe you need to take less. Maybe you need to convert some to Roth so you're not paying 6 figures in taxes like Paul and Carol. Maybe you need to do qualified charitable distributions if you don't need the money to live on. The point is, don't let the fear of taxes keep you from enjoying the money you've worked so hard for. There's a sweet spot between enjoying your money and managing your tax burden. We just need to find it. And this will be different for everybody. There's no one-size-fits-all answer or magic formula. There's only the work of figuring out what your retirement looks like and building a strategy around that. Because here's what's really happening, and this is the part nobody likes to talk about. Most people I work with have spent 30 to 40 years in accumulation mode. They save more, invest more, and watch it grow. But then you hit retirement and suddenly you're supposed to flip a switch and start spending your own money. I've found that's terrifying for most people, especially the ones who are really good savers. I've seen it happen over and over again. People get stuck in this mindset of, I need to save for that one day expense, even though once you hit retirement, that is the day you've been saving for, right? But they'd rather take the minimum and preserve their wealth as long as possible. But they're actually limiting the life they get to experience. And here's the thing. The required minimum distribution, the tables that they're used to calculate those numbers, they aren't meant to be used as a retirement withdrawal strategy. They're a tax collection strategy, right? The IRS doesn't care about your retirement goals. They just want their money. So everyone's asking, how much should I take for my RMD? And honestly, I think that's the wrong question. Start asking, what kind of life do I want to live? And how do I optimize my withdrawals to support that lifestyle? Start there. Because here's what I've found after working with, hundreds of retirees over the years. Many people taking only the minimum from their IRAs are shortchanging themselves out of something they've worked so hard for. They're trying to preserve wealth for the future when their future is right now. So don't fall into the trap of just trying to accumulate the most money possible. You'll miss the entire point of saving and investing in the first place. So those who are taking only their required minimum distributions aren't making a mistake. They're just not asking the right questions. The question isn't how much should I take? The question is, how do I optimize my entire financial picture to support the life I want to live? And if taxes are a consequence of my financial plan, what can I do ahead of time to minimize that impact? That's the conversation you should be having with your advisor, and that's the planning you should be doing. Now, some of you may have a bunch of other accounts in addition to your 401k or IRA, and a common question I hear a lot is, which retirement account should I withdraw from first when I retire? I did a video answering this exact question, and it's quickly become one of the most popular videos on my channel. So to check that video out, click here, and I'll see you over there.